Ready for a deep dive. Today, we're tackling the psychology of personal finance.
Oh,
This is going to
interesting.
be fascinating. I think we're
Okay.
looking at a chapter from Keith Redhead's book, Personal Finance and Investments.
Okay.
And it's not your typical, like,
Right.
how to invest kind of book. It really gets into the nitty-gritty of the psychology behind our money choices.
It does. And you know what I find so intriguing about Redhead's approach is he goes beyond like the mechanics of investing and really delves into the psychological factors that
Hmm.
can really influence our decisions.
For better or worse, right?
Exactly, for better or for worse.
Yeah, so let's start with a basic question, like when you think about your own investment goals,
Yeah.
what comes to mind?
Well, naturally, we all want high returns
Sure.
with minimal risk,
Yeah,
right?
of course. Who haven't?
But I think what's important is, and Redhead highlights this, aligning your investment objectives with your individual circumstances,
Okay.
which often act as constraints on your choices.
Constraints. So it's not just like picking stocks out of a hat.
Right. Exactly.
There are other things that come into play.
Yeah, absolutely.
What are some examples of those constraints?
Well, think about your age,
Okay.
your income, existing assets,
Hmm.
family situation, even like your ethical beliefs can play a role.
Oh, interesting.
For example, someone nearing retirement has a very different time horizon
Right.
than someone just starting their career, right?
Makes sense.
So their investments need to reflect that shorter time frame.
Yeah, a younger person has more time to kind of ride out those
Exactly.
market fluctuations.
Yeah.
Someone closer to retirement probably wants a little more stability.
Yes, absolutely.
What about risk?
Yeah,
It feels like that's a word that gets thrown around a lot in personal finance, but
it does.
what does it actually mean?
Right. So Redhead breaks down risk into different categories,
Hmm.
and it's more nuanced than a lot of people think. There's market risk, which is the potential for your investments to lose value due to overall market movements.
Mm-hmm.
Then you have interest rate risk, which affects bondholders when interest rates rise.
Got it.
Inflation risk, which erodes the purchasing power of your money over time.
Okay, so it's not just one big scary monster. It's
Yeah.
like different
Different
flavors
risk.
of risk.
Exactly.
So how do we figure out our own risk tolerance?
That's a great question.
Is there like a test you can take or something?
There are questionnaires and assessments, but I think ultimately it comes down to honest self-reflection.
Hmm.
How much volatility can you stomach without losing sleep at night?
Yeah,
How would you react if your portfolio dropped 10% or even 20%?
right.
And, understanding your risk tolerance is really crucial because it helps you make investment choices that align with your,
Your comfort level.
yeah, your emotional capacity.
It's like knowing your limits, right?
Exactly.
Pushing yourself too far could lead to some bad decisions.
Absolutely. And this is where it gets really fascinating.
Okay.
Redhead dives into the psychology behind our financial decisions.
Uh-huh.
And spoiler alert,
Okay.
we're not always as rational as we like to think.
I was about to say.
Yeah.
I was going to say, that sounds about right.
Right.
So what are some of those biases?
Yeah, what are some of those mental traps?
What are we looking out for?
Well, one of the biggest culprits is overconfidence.
Okay.
We tend to overestimate our abilities, our knowledge, especially when it comes to investing.
Hmm.
And this can lead to excessive trading, under diversification,
Oh, interesting.
ultimately poorer returns than if we had taken a more measured approach.
So it's like a little knowledge is a dangerous thing.
It can be, yeah.
You think you've got it all figured out, but you're maybe missing something.
Right, exactly.
Or overestimating your ability to time the market. Or
Exactly. And there's a
Okay.
ton of research to back this up.
Yeah.
One study by Terrence O'Dean found that investors who traded frequently actually underperformed.
Wow.
Those who traded less often, largely due to overconfidence and the costs associated with those trades.
That's really interesting.
It is.
So what's the antidote to overconfidence?
Well, I think awareness is a big first step.
Mm-hmm.
Recognizing that you might be susceptible to overconfidence and consciously challenging your assumptions.
Yeah.
Before making a big investment decision, ask yourself, am I being realistic about the potential risks and rewards?
Mm-hmm.
Have I considered all the angles?
Right.
It can also be helpful to seek a second opinion
Yeah.
from a trusted financial advisor or someone you respect.
It's like a reality check.
Exactly, like a sounding board.
Yeah, someone to bounce ideas off of.
Yeah, to make sure you're not letting your ego
Mhm.
drive the bus.
Exactly.
Another bias to be aware of is hindsight bias.
Okay.
You know that I knew it all along phenomenon.
Oh, yeah.
It's so easy to look back on past events and convince ourselves that we predicted the outcome.
Yeah, totally.
But this can prevent us from learning from our mistakes.
So we're basically rewriting history.
We are, yeah.
to fit our own narrative.
We're filtering our memories to fit the current reality.
But how does that affect our financial decisions, though?
Well, let's say you invested in a stock that performed poorly.
Well.
With hindsight bias, you might tell yourself, oh, I should have known that company was going to tank.
Right.
But were there really clear signs at the time?
Yeah.
Or are you just filtering your memories to fit the current reality?
Right.
Hindsight bias prevents us from honestly assessing what went wrong,
Yeah.
making it harder to make better decisions in the future.
So we're robbing ourselves of lessons
We are.
because we're too busy,
Yeah.
patting ourselves on the back for being right all along.
Exactly.
Okay, so overconfidence, hindsight bias. What about representativeness?
Oh, that's a good one.
That one always trips me up, I'm not gonna lie.
Yeah. So, representativeness bias tricks us into believing that past trends
Okay.
will automatically continue into the future. We see a company with a string of successful quarters
Right.
and assume it's a guaranteed winner.
Yeah.
But good companies don't always equal good investments.
Oh, that's a good point.
Right.
Yeah.
You know, it's like we're extrapolating past performance without considering other factors that might affect future returns.
Gotcha. Can you give us an example of that, how that plays out in real life?
Yeah, Redhead mentions the Nifty 50 stocks in the 1970s.
Okay.
These were blue-chip companies with solid track records, but their prices got so inflated
Wow.
that they eventually underperformed for years.
Oh, wow.
Investors were extrapolating past performance without considering other factors that might affect future returns.
Gotcha. So it's a reminder that past performance isn't always indicative of
That's right.
future results.
You got it.
Yeah, we got to look beyond the hype. Consider the bigger picture.
Absolutely.
Are there any other biases lurking in the shadows
Oh, there are plenty more.
that we should be aware of?
We'll get into those next time.
All right, we'll be back.
Welcome back. You know, it's fascinating to explore these psychological quirks that influence our financial decisions.
I know, right? It's like these hidden forces pulling the strings.
Yeah, exactly.
So last time we were talking about all those cognitive biases like overconfidence, representativeness.
Right.
What other mental traps should we be on the lookout for?
Well, there's status quo bias,
Okay.
which is our tendency to stick with what's familiar, even if it's not the best option.
Yeah.
Think about, those default settings on your phone or computer.
Oh, yeah.
You probably rarely change them, even if there are better alternatives available.
Totally guilty of that.
Yeah.
But how does that play out in our finances?
Well, Redhead cites a study on the Swedish pension scheme,
Okay.
where despite having a wide range of investment options, a significant number of participants stuck with the default fund, even when it wasn't the most suitable for their needs.
So we're choosing comfort over potential growth.
It could be, yeah. Change can be intimidating.
Yeah.
So we often default to what's comfortable,
Right.
even if it means potentially missing out on better outcomes.
So how do we break free from that inertia?
Well, it starts with recognizing that the status quo isn't always the best option.
Okay.
Take the time to review your investments periodically and ask yourself if they're still aligned with your goals and risk tolerance.
Yeah.
Don't be afraid to make adjustments as your circumstances change.
Right. It's easy to set things and forget about it.
Right.
But our financial lives are always changing.
They are.
What about narrow framing? I've heard that term before, but I don't fully understand it.
So narrow framing is like tunnel vision.
Okay.
We get so fixated on a particular aspect of a situation that we miss the bigger picture.
Okay.
In investing, this often manifests as focusing on short-term fluctuations instead of our long-term goals.
I can see how that would be a problem.
Right.
You get caught up in the day-to-day and forget about your
Got it.
long term.
Redhead uses the analogy of missing the forest for the trees.
Okay.
Let's say the market takes a dip and your portfolio drops 5%. If you're narrowly focused on that immediate loss, you might panic and sell.
Yeah.
Even if your long-term investment horizon allows for those fluctuations,
Right.
you've essentially lost sight of the forest, your overall financial goals,
Okay.
because you're too focused on a single tree, that short-term dip.
It's like we need to zoom out.
Exactly.
Remember why we're investing in the first place.
Yes.
Don't get caught up in the day-to-day.
Absolutely.
Speaking of zooming out, Redhead also talks about mental accounting,
Yes.
which seems like another way we compartmentalize our finances.
It is. It's how we tend to categorize our money into different mental buckets, even though it's all fungible in the end.
Right.
We might have a savings account, a vacation fund, an emergency reserve.
Right.
But in reality, it's all just money.
So why is that a problem? Doesn't it make sense to have some organization?
To a certain extent, yes,
Right.
but mental accounting can lead to some irrational decisions.
How so?
Redhead gives the example of someone who diligently saves for a down payment on a house
Okay.
while simultaneously carrying a high-interest credit card balance.
Oh. Yeah.
Logically, it would make sense to use some of those savings to pay down the debt,
Right.
but because they've mentally earmarked that money for the house,
Okay.
they're hesitant to touch it.
So we're letting these mental categories dictate our behavior,
We are.
even when it doesn't make mathematical sense.
Yeah, we're playing mind games with ourselves.
It's like we're our own worst enemy.
Sometimes, yeah, and
Yeah.
these cognitive biases, while fascinating in their own right,
Mm-hmm.
really come to life when we start to consider the role of emotions in our financial decisions.
Oh, that's a great transition.
Right.
We've been talking about the brain, but what about the heart? How do emotions play into our relationship with money?
Well, Redhead highlights some intriguing research that suggests that even something as seemingly unrelated as sunshine can impact stock market returns.
Really?
Yeah, a study by Hirschleifer and Shumway found that stock markets tend to perform better on sunny days,
Interesting.
potentially because people feel more optimistic when the sun is shining.
Okay.
And that optimism can translate into more buying behavior.
So good weather equals good vibes equals a more bullish market.
In a way, yeah.
Never would have thought of that connection.
Sure.
So does that mean we should all be checking the weather forecast
Probably not.
before we make investment decisions?
Right. It's more about illustrating the broader point that our emotions,
Okay.
even seemingly subtle ones,
Yeah.
can influence our financial behavior in ways we might not consciously realize.
So it's not about predicting the market based on the sunshine,
Right.
but more about recognizing that our emotions are always at play,
Exactly.
even when we think we're being completely rational.
Precisely. And this ties into a concept called social mood theory,
Okay.
which Redhead also explores.
Mm-hmm.
This suggests that collective optimism or pessimism can influence market trends,
Mm-hmm.
leading to those boom and bust cycles we often see.
Yeah, I can definitely relate to that. Think about how contagious excitement can be
Right.
when everyone's talking about a hot new investment.
Exactly.
It's easy to get swept up in the hype.
Yeah, that's a perfect example of social influence at play.
Right.
And it works both ways. When fear and pessimism take hold,
Mm-hmm.
it can lead to panic selling,
Yeah.
a rapid market decline, even if the underlying fundamentals haven't changed that much.
It's like a self-fulfilling prophecy.
It can be, yeah.
If everyone believes the market's going to crash,
Right.
their actions might actually make it happen.
Exactly.
This brings us to one of the most powerful emotional forces in personal finance,
Yes.
loss aversion.
Yeah,
Redhead really emphasizes this
he does.
as a key element of prospect theory.
Prospect theory, in simple terms, explains why the pain of a loss feels more intense
Okay.
than the pleasure of an equal gain.
Interesting.
Imagine you had the chance to win $100 or avoid losing $100.
Mm.
Most people would choose to avoid the loss,
Yeah.
even though the amounts are the same.
It's like that feeling of dread
Right.
when you realize you've lost your wallet.
Exact.
It's more than just the inconvenience.
Yeah.
It's that like gut-wrenching feeling of
It is.
losing something.
It's because losses loom larger in our minds than gains.
Oh, okay. So how does that play out in our investment decisions?
Well, it explains why we tend to hold on to losing investments for too long,
Oh, yeah.
hoping they'll bounce back.
Hoping and praying.
Right, and why we might sell winning investments too early,
Mm-hmm.
afraid of seeing those gains disappear.
The classic sell winners, hold losers dilemma.
Exactly. We're so afraid of that feeling of regret
Yeah.
if we admit we made a mistake
Yeah.
that we end up making things worse. And it's not just about individual stocks.
Okay.
Loss aversion can affect our overall investment strategy.
How so?
We might be overly cautious,
Mhm.
avoid taking on enough risk to achieve our financial goals,
Yeah.
all because we're terrified of experiencing a loss.
So it's a balancing act.
It is.
We got to be aware of it,
Yes.
but not let it paralyze us.
Exactly.
So how do we do that?
Well, one helpful approach is to focus on the long term.
Okay.
Instead of obsessing over daily market fluctuations,
Mhm.
remind yourself of your overall investment goals,
Yeah.
the time horizon you set.
Right.
This can help put short-term losses into perspective.
It's like that saying, time in the market beats timing the market.
Exactly.
Yeah.
Another strategy is to reframe your thinking about losses.
Okay.
Instead of viewing them as failures, try to see them as learning opportunities.
Mm.
Every investment decision, whether it turns out well or not,
Right.
provides valuable insights that can inform your future choices.
So it's about shifting our mindset
It is.
from avoiding loss at all costs
Yeah.
to embracing the learning process.
Exactly.
And that leads us to another big topic.
Yeah.
Saving.
Saving.
We all know it's important,
We do.
but it can be a real struggle,
It can be.
especially when there's so many tempting things to spend our money on.
So many shiny objects.
Exactly.
Redhead dives into the psychology behind saving
Okay.
and highlights some fascinating research on how we can use behavioral insights to boost our savings rate.
Okay. What are some of those insights?
Well, one of the most effective strategies is to automate the process.
You mean like setting up automatic transfers from our checking to our savings?
Exactly. By automating the process, we're essentially taking our emotional brains out of the equation.
Okay.
We don't have to actively decide to save each month. It just happens automatically.
It's like paying yourself first before
Exactly.
you even have a chance to spend it on something else.
You got it.
Another helpful strategy is to reframe our thinking about saving. Instead of focusing on what we're giving up by saving,
Right.
we should try to emphasize the future benefits we're gaining.
Exactly. Like financial security, peace of mind, the ability to achieve our long-term goals.
So it's about shifting our perspective
It is.
from deprivation to empowerment.
Exactly.
I like that.
And there are other behavioral nudges that can encourage us to save more,
Like what?
like rounding up our purchases to the nearest dollar
Okay.
and automatically transferring the difference to a savings account.
Oh, yeah.
Or committing to saving a portion of any future pay raises or bonuses.
Oh, that's a good one.
Right.
It's like tricking your brain into saving more
It is.
without even realizing it.
Exactly.
Redhead also talks about a program called Save More Tomorrow,
Yes.
or SMART,
Smart.
which seems like a really innovative approach
It is.
to boosting savings rates.
The SMART program, developed by economists Richard Thaler and Shlomo Benartzi,
Okay.
is a fantastic example of how behavioral economics can be applied to real-world problems.
It encourages people to commit to saving a portion of their future pay increases.
So instead of cutting back on spending now,
Right.
we're pledging to save a portion of money we haven't even earned yet.
Exactly.
That's brilliant.
It is. It's a win-win.
Yeah.
Because you're not reducing your current take-home pay,
Right.
and you're automatically increasing your savings as your income grows.
I love that.
The program leverages our natural tendency to stick with the default option and our aversion to losing what we perceive as ours,
Yeah.
even if it's a future gain.
So we're outsmarting our own biases.
We are, yeah.
The SMART program is a great example of how understanding the psychology of saving can lead to
Exactly.
really innovative solutions.
Welcome back to our deep dive. It's mind-blowing how much our minds influence our money choices, even subconsciously.
It really is. We've talked about all those biases and emotions that are at play, but just being aware of them isn't enough. How do we actually use all this knowledge to make smarter financial decisions?
Yeah, that's the million-dollar question. We've covered overconfidence, loss aversion, the power of framing, and even sunshine's impact on markets. It's a lot. What are some key takeaways we can use in our own lives from Redhead's research?
Well, I think one of the most powerful things is understanding our individual tendencies. Like, if you know you're prone to overconfidence, you can build in safeguards. So before you jump into a big investment, seek a second opinion. Maybe set a rule for yourself, like you have to sleep on it before hitting that buy button.
So build in systems that work against our natural weaknesses, like checks and balances.
Exactly. And we can use this with saving, too. Remember those automatic transfers we talked about?
Yeah.
That's a great example of designing a system that works with our psychology, not against it.
It's like automating good habits.
Yeah.
So we don't always have to rely on willpower.
Exactly.
And Redhead also talked about different investor types. Can you remind me what those were again?
Oh, right. He had a couple of classifications, one based on research by Beckett and another by Keller and Segrist. One focuses on how involved folks get in the investing process. Some people love to research and manage things actively, while others are more hands-off, maybe rely on an advisor.
It makes sense that different personalities would approach investing in different ways. What was the other classification?
That one looks more at goals and risk tolerance. They have categories like money dummies, open books, risk seekers, safe players, fun names.
Yeah.
But the idea is to recognize your own motivations.
Money dummies. That's a little harsh, but I guess some people just aren't that interested in finance.
It's not a judgment, just recognizing different priorities. Someone like that might value simplicity and convenience over getting the absolute highest returns, What matters is finding what fits your values.
So self-awareness is key. Knowing yourself helps you pick the right strategy and even get the right help. Like, if you know you're someone who needs more guidance,
Right.
maybe working with an advisor is a good fit for you.
Exactly. And don't be afraid to ask questions. Challenge your advisor's recommendations if you're not comfortable, because even experts have biases, right?
That's true.
Critical thinking is super important with all these decisions.
Redhead's work is really eye-opening. I feel like I understand my own financial psychology so much better now.
That's great to hear.
What's the biggest message you hope listeners take away from this?
Hmm. I think it's that we're not always rational with money, but understanding those biases and emotions, that's where we can start making more conscious, informed choices.
Mhm.
We can design those systems that help us get help when we need it and ultimately have a healthier relationship with money overall.
It's not just about getting the biggest returns. It's about choices that align with our values and make us feel good about our finances. Thanks for joining us on this deep dive.